Okay, let's take a look at this capital leasing problem from the perspective of the lessee. It's exercise 15-3. Manufacturer Southern leased high-tech electronic equipment from Edison Leasing on January 1st, 2009. Edison purchased the equipment from International Machines at a cost of $112,080. And here's what we know, and I'll just read this and you can watch as my mouse highlights it. To the left of my mouse there, the lease term is 2 years and there's 8 quarterly payments. The quarterly rental payment is $15,000, which has to be made at the beginning of each period. The economic life of the asset is 2 years. The fair value of the asset is equal to the amount of the lease transaction, $112,080, and the implicit interest rate is 8%, which is also the lessee's incremental borrowing rate. Okay, well, what's required? To the left of my mouse it says prepare a lease amortization schedule and appropriate entries for Manufacturer Southern from the inception of the lease through January 1st, 2010. Depreciation is recorded at the end of each fiscal year, which is December 31st, on a straight line basis. All right, so let's tackle a Part A. And I'm going to slide the screen up just a little bit so we can see what we have there. All right, now I've worked this ahead of time to save us some trouble with this first requirement. There's we'll cover the entries in a little bit. But what we know, first off, is the outstanding balance starts out at $112,080. Now you can also look up here to the formula bar, right? And if you hit this, you'll get a pop-up screen that'll insert the function. But the formula bar will also show you what's in the cell. So I've got that appearing on the screen. Now the payments made at the beginning of the period, so the beginning of period 1, we know there's a $15,000 payment. Since that's exactly when the lease is signed, there's no interest that's accrued. So the effective interest, essentially the interest that's owed at that point, is 0, right? But we do decrease the balance of the amount by 0 as well. This is the decrease in the balance of the outstanding, I'm going to call it the lease obligation. But by the end of period 1, we record the reduction of the $15,000, and that gets us to $97,080. So these two columns here, all down here, is going to relate to the interest and the reduction up to the point at which we need to make an entry or make a payment. Okay, so if we know the balance is $97.80, we know in this period 2 and every period thereafter, and these are quarterly payments, we've got a $15,000 payment, we can bring that to light. Now the effective interest rate here is calculated by what you see either on the formula bar or right here. Take the value in F22, which was the outstanding balance from the previous quarter, and multiply it times the incremental borrowing rate divided by 4 to come up with the periodic rate. So I mean, we could just use 2%, right? You could do that in your head, but I chose to show it in the detail. So it's 8% divided by 4, which is 2% times the 97,080, which is 1942. Then the decrease in the balance of the principal becomes the principal payment, but we've got to add back the accrued interest. So the decrease in the balance is really just the $15,000 less the 1942 of effective interest. And when we do that, we can then compute the outstanding balance, which says take the remaining outstanding balance, which was in cell F22, and subtract off the amount of the principal that gets reduced. Okay, so the amount of the loan that gets reduced by the payment going towards principal, and that gives us to $84,022. Now once we have that, all of these formulas that you see can then just be copied from below, because it's a repeating event and a repeating calculation. So I'll just copy all of these into those cells there, and we see that the outstanding balance works its way down to 0. And you can now go inspecting any one of these cells to see, how it was derived, right? Okay, so we take the previous amount times 2%, then we take the previous amount less the $15,000 payment, add back the effective interest because a portion of that payment goes to interest, not to principal, and then we know how much is the decrease in the balance of the obligation, which we're calling principal, and subtract that amount from the previous balance, and then we just keep working it forward. And that takes care of the first portion of this requirement, which is to prepare the amortization schedule. Okay, now I've rearranged the screen so that we have the amortization schedule in front of us, and we'll record the entries that the lessee would have to make. All right, on January 9, we need to record the capital lease. So we're going to debit an account. Let's see, where should I put the debits and credits? We'll put the debits here. We're going to debit leased equipment, and it's going to be equal to, no, you know what, I'm going to move this back here so we've got some room. The leased equipment is going to be equal to the amount of the contract for the lease at the fair value, which was $112,080. And then we also have a lease payable to record. So let's indent that so that we have the normal debit credit format. And that, of course, is equal to the same amount. And that's our entry to record the lease. But then we immediately turn around and debit leases payable, right, for the amount of the first payment, and we credit cash. So I'm going to debit cash here to record that payment of the $15,000. And I will just format this cell so that it gets the same indentation. And those are the two entries we make on January 1st. Now, really, we should add a line and describe, what the entries are for to show it in proper form. So the first entry, this here would be, we would add a line that should say to record entering into a capitalized lease arrangement. Okay, and then this one would be to record the first payment. But this actually would be made probably through accounts payable, and that it would be more of a automatic entry rather than a manual one made in a general ledger. But to show the debits and credits, we'll leave it as is. All right, now let's tackle the next payment. Okay, the next payment we have to record the interest expense and the lease payment as well. So what we need to do is record all of those necessary entries. I'm going to record the lease payable first. Okay, so we've got a lease payable account, right? This one would not be indented, so let's format from here. And that lease payable is going to be equal to, this is on 4/1, which is the second period. The first period would be January 1, 2009, 1358. And then we also have to debit interest expense. And interest expense is going to be equal to that 1942. And then we're going to credit cash, which is going to be equal to 15,000. And if I've done it right, 15,000 would be equal to the sum of those. And it is. Okay, then we have the exact same entry again. I'm going to just copy this and change the amounts that we would need to make on 7/1/2009. So let me change the amounts here. Okay, so the amount here that would become one row below the 13,320, and the interest expense becomes the 1680. And then the formula in cell F42 would be correct. Okay, and we would do that for all of the entries. Once we get to the end of the year, though, we'd need to record depreciation. Okay, now in the interest of saving time in this demonstration, I'm not going to work through the other entries for periods 3, 4, 5, 6, 7, and 8, but I will illustrate depreciation that gets made on 12/31. So we need to record depreciation expense. And they told us it's the straight line method. We'll assume there's no salvage value. And the depreciation expense is going to be debit equal to the cost of the leased asset divided by 2, right? 2 years, $56,000, with a credit to accumulated depreciation. And I'm going to indent that. And that will be equal to 56,000. And that takes care of this problem.